Hello friends, I am Ram. Welcome to FinShoppy. Today in this video, I am going to discuss about portfolio overlapping. So, do you invest in many funds related to same category? Do you have same fund manager funds in your portfolio? Or did you have overexposure to any particular sector? If your answer is yes, any of these questions, this video is for you. Unfortunately, many investors don't know about what is portfolio overlapping and what is portfolio allocations. So, we would be focusing on this point. Briefly, I would explain what is portfolio overlapping is with one example. For instance, you have invested in two funds. Each fund consists of 50 stocks. You thought that you invested in 100 stocks. But reality is 25 stocks are same in both the funds. So with this example, you come to know that you have invested only 75 stocks but not 100 stocks as you think of, and you have taken more exposure to 25 stocks. It means 50% of your investment you invested only in 25 stocks and remaining 50% invested in other 50 stocks. So you have taken concentration risk. To understand this concept, we will discuss 3 points on this concept in a detailed way with real examples. So, first point is having more funds in the same category in our portfolios. Companies overlap happens mostly because of we invest same kind of category of funds, like we invest more than 2 or 3 funds of large caps. Unfortunately, all these large cap funds invest same set of companies. Investors think that they are diversifying their portfolio by investing different AMC funds, but unfortunately they are getting same set of companies. Instead of diversifying investments, they are actually getting the concentrated risk by taking more exposure on same set of companies. Now let us see the example. In a given example, I have taken SBI Blue Chip Fund and Aditya Birla Sun Life Frontline Equity Fund. In terms of money invested in these two companies, 53% is overlapped in these two fund set of portfolio. But when you take one large cap fund and one mid cap fund, say for example, in our example, I have taken SBI Blue Chip Fund again as a large cap fund and HDFC mid cap fund as a mid cap fund. So if we check the overlapping in these two funds, 6% portfolio is only overlap. This is acceptable overlapping. You cannot avoid completely, but having overlapping 40-50% is not good for portfolio. Second point from our discussion is buying multiple funds managed by the same fund manager. So we may like one particular fund manager and we tend to buy whatever fund he is managing. So that is not a good idea, because fund managers usually habituated some kind of investment approach over a period of time. They usually do not deviate from their approaches. So if he is managing more than two funds, for example, if he is managing two funds, there is a most likely chance that he select same set of companies in those. Now let us see the example on this point. I have selected two funds which are managed by the same fund manager. These are Mirae Asset India Equity Fund, Mirae Asset Emerging Blue Chip Fund. When you check overlapping in these two funds, 59% is overlapped. That is too high. As discussed, these overlapping happened because these two funds being managed by the same fund manager. When you check same set of category funds which are managing by different fund managers, like I have taken two other funds having same categories, like Mirae Asset India Equity Fund is multi-cap and Principal Emerging Blue Chip Fund as is large and mid-cap, like Mirae Asset Emerging Blue Chip Fund, which is also large and mid-cap fund. When you check overlap in these two funds which are being managed by two fund managers, overlapping percentage is 24%. So now you can check how overlapping is affected when funds are being managed by same fund manager and the different fund manager. So you can overcome this overlapping effect by investing with different fund managers. As you know, in India we have 40 plus fund houses and there are many skilled fund managers. So take the benefit of in investing in different fund managers instead of one or two. So third point from our discussion is having more exposure to particular sector. Sometimes most of the mutual funds takes high exposure to one sector which is having bullishness. Like in 2017, for example, like in 2017, Nifty and Sensex having more than 30% of weightage in banking and finance sector. So in the same way, most of the mutual funds also taken even more exposure than 30%, like up to 40% also exposure taken on this sector, because this sector was very bullish in 2017. So after recent liquidity issues and NPA issues came to light, this sector affected very badly, and the funds also in the same way, and these funds also who have taken more exposure to this sector affected very badly. So one more example for these sector things, like in 2017 and 16, these chemicals and oil companies did very well. So many mid and small cap funds have taken very good exposure to those sectors, but after recent crude oil prices increase in 2018, these sectors affected very badly. Consequently, these funds also affected very badly. So as an investor, you should check that whether any unnecessary exposure is there in your portfolio or not. So that's it, friends, about this topic discussion. Hope you like it. Please subscribe to my YouTube channel and share it to your friends. Thank you so much.